In 1973, millions of Americans watched their savings get absolutely destroyed. The stock market collapsed by 45%, unemployment exploded, and the cost of just living, groceries, gas, heating your house, went through the roof. But here's the part nobody talks about. While regular people were getting wiped out, a small group of investors got filthy rich. They saw it coming. They understood the pattern, and they positioned themselves perfectly before everything fell apart. Right now, in 2026, that exact same pattern is forming again. I want to be very clear with you about something. I'm not here to scare you. I'm not here to predict the future. Nobody can do that. But what I can do is show you what happened last time the economy looked exactly like this. Because history has a habit of rhyming, and if you understand the rhyme, you can actually use it. So let me break this all down. The setup, why the 1970s matter right now. To understand what's happening today, you have to go back about 50 years. Because the early 1970s were one of the most chaotic, confusing, and ultimately wealth redistributing periods in modern American financial history. Here's the foundation. In 1971, President Richard Nixon made a decision that changed everything. He announced that the United States dollar would no longer be backed by gold. Before that moment, every dollar in circulation was tied to a physical amount of gold sitting in a vault. That gave the dollar its value. It gave it a ceiling. It gave it discipline. Nixon removed that ceiling, and he went on national television and said it himself. He announced he was directing the suspension of the convertibility of the dollar into gold or other reserve assets. He called it temporary. It was not temporary. It fundamentally restructured the entire global financial system practically overnight. So what happened next? Well, when you remove the discipline from money, when there's nothing physically tethering how much of it can exist, governments and central banks can print more of it. And that's exactly what happened. The printing presses started running. Government spending accelerated. And for a while, it felt great. The economy was humming. But then the bill came due. That extra money chasing the same amount of goods meant prices started climbing. Inflation crept up, and then it ran. The value of the dollar started to erode. People could feel it at the grocery store, at the gas station, in their monthly bills. And then, right in the middle of all of that, the Middle East exploded. The oil shock that broke everything in 1973, the United States supported Israel during the Yom Kippur War. It was a geopolitical decision. And the Arab members of OPEC, the Organization of Petroleum Exporting Countries, responded by cutting off oil exports to the United States entirely. Think about what that actually means for a second. Oil isn't just gasoline. Oil is the backbone of a modern economy. It heats your home. It powers the trucks that stock the shelves at your grocery store. It fuels the ships that carry imports across the ocean. It goes into plastics, chemicals, fertilizers. When oil prices spike, everything spikes. Every single thing you buy gets more expensive because every single thing requires energy to produce and to ship. And oil prices didn't just go up a little. They quadrupled. In less than a year, people were lined up for hours at gas stations. Some stations ran out entirely. There were odd even rationing systems where you could only buy gas on certain days depending on your license plate number. The economy, already stressed by inflation, just got hit by a freight train. The Federal Reserve's response, and why it changed history. So now the Federal Reserve Bank is staring down a nightmare scenario. Inflation is running hot. Oil prices are through the roof. The dollar is losing value, and they have to do something. So they raised interest rates. Not a little, not gradually, dramatically, aggressively. We're talking about mortgage rates that climb to 12%, 15%, even 18% annually. To put that in perspective, today people complain when mortgage rates hit 7%. Imagine paying 18% interest on your home loan. That's not a typo. 18%. The logic made sense in isolation. If you raise the cost of borrowing money, people borrow less. If people borrow less, they spend less. If people spend less, prices stop rising as fast. You choke the inflation out of the system, but the cost was enormous. The stock market crashed by about 45% between 1973 and 1974. Unemployment soared. Companies that had borrowed heavily to expand couldn't afford their debt payments anymore. Businesses shuttered. The economy went into recession even while inflation was still elevated. A brutal combination economists call stagflation. You're getting the worst of both worlds at the same time. Rising prices and a shrinking economy. It's supposed to be impossible. And yet there it was. For most investors, it was a catastrophe, but not for everyone. The three assets that made people rich while everything else burned. Here's what almost nobody in the mainstream will tell you about the 1970s. While stock market investors were watching their portfolios get cut in half, while bond investors were getting crushed by rising rates, while people holding cash were watching inflation slowly eat away at their savings, three specific asset classes were absolutely on fire. Number one, gold. Gold was the clearest winner of the entire decade. When Nixon took the dollar off the gold standard, gold was essentially capped at around $35 per ounce. It was artificially held down by the peg. The moment that peg was removed, gold was free, and it ran. By the end of the 1970s, gold had climbed from that $35 anchor to over $800 per ounce. That's not a misprint. We're talking about a gain of more than 2,000% in roughly a decade. Why? Because gold is money that nobody can print. When paper money loses trust, when inflation is eating purchasing power, when geopolitical tensions make the future feel uncertain, people run to gold. It's been that way for thousands of years. And in the 1970s, that instinct proved exactly right. Number two, commodities. Raw materials absolutely boomed. Oil, obviously, but also metals like copper. Agricultural products like wheat and corn and soybeans. The inflation that was destroying the purchasing power of the dollar was simultaneously pushing the prices of physical things through the roof. And here's the nuance most people miss. Commodity-producing companies, the oil drillers, the miners, the agricultural businesses saw their profit margins absolutely explode. Why? Because their costs were somewhat fixed while their revenues skyrocketed. An oil company that was pumping oil at the same cost per barrel was now selling that barrel for 4 times the price. That's pure profit going straight to the bottom line. Number three, real estate. Now this one surprises people. You'd think that sky-high interest rates, we're talking 15%, 18% mortgages, would kill the real estate market. And in terms of transaction volume, it did slow things down. But prices? Prices kept rising. Because real estate is a hard, physical asset with intrinsic utility. People need places to live regardless of what interest rates are doing. And farmland in particular went on an extraordinary run, not just because land prices were rising in nominal terms, but because the food being grown on that land was selling for dramatically higher prices. Farming became extraordinarily profitable. Land values followed. The investors who made money in the 1970s owned things. Real, physical, tangible things. The investors who got hurt were the ones holding paper, stocks, bonds, and especially cash. Now look at what's happening in 2026. The parallels are almost uncomfortable. Start with the money printing. In 2020, the pandemic hit. The government wanted to keep the economy from collapsing, so it unleashed an enormous wave of stimulus spending. Trillions of dollars were injected into the financial system in a remarkably short period of time. This wasn't coming off the gold standard. We'd already left that behind in 1971, but the mechanism was the same. More money was created. More dollars were chasing the same amount of goods, and that created the inflation problems we've been dealing with ever since. Sound familiar? It should. It's the same fundamental dynamic as the early 1970s. Excess money creation followed by inflation. And now look at the Middle East. The United States attacked Iran in early 2026. Oil prices jumped almost immediately. Businesses started reporting higher than expected inflation in the very same time window. The Federal Reserve, which was being widely expected to cut interest rates in March 2026, suddenly found itself in a very complicated position. Cut rates and risk making inflation worse? Keep rates steady and let the inflation problem fester? Raise rates again and potentially trigger a new economic slowdown? This is the exact same impossible choice the Fed faced in the early 1970s. And the decision they make, and how markets respond, will likely determine where wealth gets created and where it gets destroyed in the years ahead. But here's what's different this time now. I said history rhymes. I didn't say it repeats exactly. There are 4 genuinely important differences between 2026 and the 1970s, and you need to understand all of them. Difference number 1, tariffs. In the 1970s, inflation was being driven by 2 things: money printing and oil prices. That was basically it. Today, we have a third factor: tariffs. When you put tariffs on imported goods, the businesses importing those goods pay more, and companies don't eat that cost. They pass it on to you. Higher prices on imported goods compound everything else that's already pushing inflation higher. It's like pouring gasoline on a fire that's already burning. Difference number 2. The Federal Reserve itself is different. In the 1970s, the Federal Reserve was committed to fighting inflation no matter what. They were willing to crush the stock market. They were willing to cause a recession. They were willing to make mortgage rates painfully unaffordable. Whatever it took to wring inflation out of the system and preserve the long-term value of the dollar, they were going to do it. Today, the environment is fundamentally different. The current administration has been vocal about wanting lower interest rates. There's a new Federal Reserve chairman coming in as of May 2026 who has signaled alignment with that preference for lower rates. Now, and this is important, one person doesn't control the federal decisions require a majority vote from the full committee. But the tone at the top matters enormously for how that committee discusses and weighs its options. A Fed that's being politically pressured to cut rates during an inflationary period is a very different animal than the Fed of the 1970s. And that difference could have significant consequences for how inflation actually gets resolved or doesn't. Difference number 3. Gold has already been running. In the 1970s, gold was suppressed at $35 an ounce when everything started. It had nowhere to go but up. Today, gold has already been climbing for years. Central banks around the world, and this is a huge shift, have been actively buying gold since the pandemic. Not individual investors. Central banks. The people who manage entire nations' foreign currency reserves have been steadily moving away from dollar-denominated assets and toward physical gold. That trend has pushed gold to record highs even before this latest oil shock. Does that mean gold can't go higher? No. But it does mean the starting point is very different. You're not buying in at $35 an ounce this time. Difference number 4, artificial intelligence. This one is genuinely unprecedented. There was no equivalent to AI in the 1970s. In that era, there was a basket of stocks called the Nifty 50, the 50 largest, most dominant companies in America. Think Xerox, think Polaroid, think IBM. Everyone believed these companies were so dominant, so irreplaceable, that they would always go up. Their stock prices were trading at enormous premiums. And then when the Fed started raising rates, those stocks got absolutely decimated. That crash dragged the entire market down with them. Today, we have the Magnificent Seven. 7 technology companies that dominate the stock market's total capitalization. And many of them are deeply embedded in the artificial intelligence build-out happening right now. The question that nobody has a confident answer to is this. Are these companies the Nifty 50 of 2026, overpriced and vulnerable to a dramatic crash the moment conditions change? Or is AI genuinely transformative enough to sustain their valuations even through turbulence? We've seen bubbles before. The dot-com crash of 2000, the housing bubble of 2008. Both times, the underlying technology or concept was real and valuable. The internet was real. Housing was real. But the prices got so disconnected from reality that they had to correct violently before eventually recovering. Is that what happens with AI stocks? Or do they just keep climbing because AI is genuinely going to reshape the economy at a speed and scale we haven't seen before? Honestly, nobody knows yet. And the uncertainty itself is part of what makes this moment so volatile. 5 ways historically these environments have created opportunity. Let me be very direct about something before I go further. Investing involves real risk. You can lose money. You will lose money at some point if you're investing over long periods of time. Nothing I'm about to say is financial advice. What I'm doing is showing you how to think like an investor by looking at what has worked historically in environments that look like this one. That's it. Do your own research. Never put in more than you can genuinely afford to lose. With that said, let's look at history. Number 1, gold. Every time the dollar has come under pressure, through inflation, through geopolitical conflict, through monetary uncertainty, gold has historically benefited. The mechanism is simple. Gold is a store of value that no government can inflate away. When confidence in paper money erodes, people move toward things with inherent value. Physical gold, actual bars and coins, represents true ownership. You hold it, you own it. For investors who want exposure without physically storing gold, exchange-traded funds like GLD or IU provide access to gold prices through standard brokerage accounts. Number 2, energy companies. When oil prices rise, the companies that produce and sell oil see their revenue increase dramatically. Their costs don't necessarily rise at the same rate, which means their profit margins can expand significantly in high oil price environments. The 1970s were extraordinarily profitable for energy companies even while the broader economy was suffering. Broad ETFs covering large U.S. energy companies give you diversified exposure across the sector rather than betting on a single company. More focused options target oil and gas exploration and production companies specifically, offering a purer play on the oil price itself. Number 3. Commodities broadly. Beyond oil, the entire commodities complex historically benefits from inflationary environments. Metals, agricultural products, industrial materials. When the purchasing power of money is declining, the price of physical goods tends to rise. Diversified commodity funds holding futures contracts across energy, metals, and agriculture have historically served as inflation hedges. More specific plays on individual commodities like copper, which has its own demand story driven by electrification and infrastructure, offer targeted exposure to particular materials. Number 4. Farmland and agriculture. This one is fascinating because it sits at the intersection of real estate and commodities. In the 1970s, not only did land values rise, the food being grown on that land became dramatically more valuable. Inflation pushed food prices higher. Higher food prices made farming more profitable. More profitable farming made farmland more valuable. It was a compounding cycle. Today, the farmland market is harder to access than, say, buying a stock. There's no broad ETF that gives you direct exposure to the farmland sector. But there are real estate investment trusts, REITs, that specialize in owning farmland and leasing it to farmers, collecting rents that historically rise alongside food prices. There are also funds that provide exposure directly to agricultural commodity prices themselves: wheat, corn, soybeans, cattle. If what you want is exposure to the food price inflation story rather than the land ownership story. Number 5. Silver. Silver occupies an interesting and somewhat unique position in this landscape. Like gold, silver is a precious metal that historically serves as a hedge against inflation and dollar weakness. When confidence in paper money drops, investors buy both gold and silver. But silver has an additional dimension that gold doesn't. Silver is an industrial commodity. It's used in electronics, in solar panels, in medical equipment, in countless industrial applications. Demand for silver is growing structurally because of the energy transition, because of expanding technology manufacturing. So silver has both the safe haven story and the industrial demand story running simultaneously. But, and this is critical, silver is significantly more volatile than gold. When gold goes up, silver often goes up more. When gold goes down, silver typically falls harder and faster. If you don't have the stomach for that kind of volatility, silver can turn into a trap. Investors buy it at the peak of enthusiasm, panic when it drops 30%, and sell at exactly the wrong time. Understanding the volatility profile going in is not optional. It's essential. The bottom line, let me bring this all together. 50 years ago, a combination of excessive money printing, dollar devaluation, and a Middle East oil shock created one of the most economically turbulent decades in American history. The Federal Reserve responded by raising interest rates to levels that seem almost impossible today. The stock market crashed. Unemployment surged. Most investors got hurt badly. But the investors who owned gold, energy, commodities, farmland, and silver didn't just survive. They thrived. They came out of the 1970s dramatically wealthier than they went in. Right now, in 2026, we're watching what appears to be a rhyme of that same pattern developing in real time. Post-pandemic money printing created inflation. A new Middle East conflict is spiking oil prices. The Federal Reserve is caught between painful options with no good choices. The differences matter. Tariffs add a new inflationary layer that wasn't there before. A Fed under political pressure to cut rates may behave very differently than the inflation-fighting Fed of the 1970s. Gold is already elevated, not starting from an artificially suppressed baseline. And AI has introduced a wild card, a potential growth engine that could either sustain tech valuations through turbulence or represent the nifty 50 bubble of this generation. Nobody can tell you exactly how this plays out. Anyone who claims certainty about where oil prices, interest rates, or the stock market are headed in the next 12 months is either lying or delusional. Markets are complex, dynamic, and frequently humbling. What history does give you is a framework. It gives you a lens for understanding which types of assets have held value and even grown in environments that look like this one. That knowledge won't protect you from every mistake, but it might help you avoid the biggest ones. The people who got hurt in the 1970s weren't stupid. They just didn't understand the pattern. They held cash while inflation ate it. They held stocks while interest rates crushed them. They held bonds while the rate environment destroyed their value. They were doing everything they've been taught was right. In normal times, it was right. But the 1970s weren't normal times. The question worth sitting with right now is whether 2026 is going to be normal times or not. Based on everything we're watching unfold, that's a question worth taking very seriously.